Good afternoon, everyone. Thanks for joining us. Welcome to our first event of 2021 and our fourth virtual event. My name is Marianne Ross. I am the VP of Trading and Investments at Sterling Asset Management. Today I'm joined by two esteemed colleagues. Furthest from my left is Mr. Dwayne Neal. He is the AVP of Personal Financial Planning. And then closest to my left is Mr. Eugene Stanley. He is the VP of Fixed Income and Foreign Exchange Trading. Thank you all for joining us today. And both of them plan to tell us a bit more about how we can earn more on our investment portfolios in 2021. Thanks again for joining us, guys. Now, just before we start, a quick housekeeping matter. If you have questions, we're going to ask that you hold them until the end. We'll address all the questions at the end, but so you don't forget them, you can type them into the chat and just make sure that the word all panelists is selected. Now we're going to go back to learning how we can earn more on our portfolios in 2021. In our last forum, we spoke a bit about the most frequently asked questions investors had in 2020. We learned two really important concepts. One, low interest rates and volatility are here to stay. And also, it is the time spent in the market, invested in the market, versus time spent trying to perfect the entryway into the market that makes a difference in our long-term returns. Today, we're going one step further to find out how we can put those insights to work to actually earn more. Now, by far, one of the most frequently asked questions is always on the exchange rate. So Eugene, I'm going to put you in the hot seat first. Everyone wants to know what's happening. When is the best time to buy? When is the best time to sell? So maybe, Eugene, could you start by just briefly summarizing the trends that you saw in the FX market in 2020?
Thank you, Marianne, for that question.
Sure.
But before I get to the trends, let me just summarize what happened with the exchange rate in 2020. And what really happened was that the Jamaican dollar performed worse in 2020 than it did in 2019, recording a devaluation of 7.8%. That was twice the level it was in 2019. The outcome, however, was not surprising given the impact of COVID-19 on crucial foreign exchange earning sectors such as tourism. But even before the hit from COVID-19, it was always going to be a damage control exercise throughout 2020, given the fact that in the first month of the year in 2020, the dollar slid almost 7%.
Wow.
And so with COVID-19, that was going to make it even that much harder for BOJ to contain the slide throughout the year. And so kudos should go to the central bank and other intervening players for pretty much for the excellent stewardship of the currency throughout the year, in ending the year with just a slightly higher devaluation than we saw in January 2020.
It's good to know.
All right. Now, as it relates to the trends, three notable patterns remained in 2020. The first being large monthly fluctuations in the exchange rate continued. We saw where at the start of a quarter, there would be a sharp depreciation, and then by the time the quarter comes to a close, there'll be a strong rebound in the Jamaican dollar. We also saw that in the very last month of each quarter, there's been an appreciation of the Jamaican dollar. And then the third observation would have been that December continued to be a very good month with respect to the performance of the Jamaican dollar.
Oh, that's good to know, Eugene. So far for 2021, have you noticed any other trends that we should know?
Quite so. So unlike 2020, well, certainly January 2020, when there wasn't much intervention from BOJ in January of 2020, we have seen that completely change in 2021. BOJ has been very active, not only in the foreign exchange market, but also in the fixed income market, as it tried to prevent a similar situation from happening this time around. And so for instance, the Bank of Jamaica would have sold US 85 million into the foreign exchange market.
Wow.
They also sold roughly 95 million of a US dollar index note. And they also took out Jamaican dollar liquidity through a local fixed rate certificate of deposit. Now, all told, with those actions from BOJ, BOJ would have reduced the supply of Jamaican dollar into the financial system by approximately 42 billion
Wow.
Jamaican dollars. And they would have added 85 million into the foreign exchange market. Now, in judging those results, we did in fact see a slower pace of depreciation in January this year. Actually ended the month roughly 4.9% compared to the 6.5% that was recorded in 2020.
Wow, that's a very active central bank we have there.
Very much so.
That has, I'm sure that those activities have a lot of implications for our investment strategies. But Eugene, maybe based on the trends that you have just described, what do I need to know for my 2021 foreign exchange strategy?
Okay. All right. So it is important to know that despite the interventions from BOJ and other players, the value of the Jamaican dollar is likely to be lower at the end of the year from where it is now. One of the main reasons for that is that the impact of COVID-19 on the tourism sector, for instance, is going to continue for some time. And when you also add to that, I mean, even though there have been discovery of vaccines, but the rollout of those vaccines in places like the US and Europe have been progressing at a slower pace than anticipated. Also, even more recently, Canada has actually suspended flights to the Caribbean, and Canada is also one of those key countries that supply tourists to Jamaica. So the impact on tourism is going to be, prolonged, which means that the shortfall in foreign exchange from the tourism sector is going to continue for some time. Now, also added to that is the historical performance of the Jamaican dollar vis-a-vis the US dollar. Historically, the Jamaican dollar has devalued against the US dollar. As a matter of fact, I think I made this point in my last presentation, that since 1991, when the currency was liberalized, there's only been 3 years where the Jamaican dollar has actually recorded an appreciation for the entire year.
Wow.
So it's doubtless it's doubtful that trend is going to change anytime soon. So long and short of it is, being and staying invested in US dollars will continue to be an investment thesis, not just for 21, but beyond 21 going forward.
Wow, that's really helpful, Eugene. Thank you. So just to recap, you're suggesting, or the data suggests that we should sell US dollars at the start of a quarter, buy US dollars at the end of a quarter, or possibly even at the end of the calendar year in December if we can. And actually not many people are aware that Sterling operates a Cambio. So if you are interested in, and you don't have to be a client to use our Cambio services, so certainly give us a call if you're looking to either buy US or sell US. We've got great competitive rates. And certainly, I think I loved your last point, Eugene. Staying invested in US dollars seems to be the name of the game, not just for 2021, but beyond. Now that we have our FX needs covered, I'm going to put Dwayne in the hot seat. So Dwayne, it's 2021, bond and stock prices are at record highs. This is great for my existing portfolio, but what about this new money, my Christmas bonus, all this new money that I want to put to work? Every day it's a bit of a struggle to find assets. Tell me, I am an investor that needs income. Where can I look for higher income levels?
Okay, thanks, Marianne. Generally, investors look for income. They look to fixed income products. So they look for bonds, repurchase agreements, or similar fixed income products. We've seen over the past few years that the interest rates on these products have been coming down and have been pretty low and don't seem to be rebounding anytime soon.
Tell me about it.
So for the investor who has a little higher risk appetite, willing to take a little more risk, then one avenue they could look at exploring is called a structured note. So what a structured note really is, it's a debt instrument issued by a financial institution, and the performance of it is linked to certain criteria being met. So the criteria is going to be linked to either the price performance of a single stock, the performance of a basket of stocks, changes in interest rates, or changes in commodity prices. So I'll give you a quick example. So let's say Sterling offered a structured note at promising to pay you at 9%, but it is linked to a basket of stocks including Apple, Exxon, and Walmart. If the price of any of those stocks should fall below 50% of the current value, then you would not receive that 9%. But once they all remain above that 50% value, then you will get your 9% interest.
Wow, Dwayne, that's a lot to handle. Okay, so let's go back to basics. You just mentioned an example, which is great. Thank you for that. Now, what happens if the price of that stock, one of the stocks in that portfolio, say Apple, falls by, say, 56% before the maturity date, but the prices of Walmart and Exxon go up in price? What happens to my interest payments, that nice juicy 9% coupon?
Well, once any of the stocks, either one or more of those stocks, fall outside of that 50% band, then you would not receive that 9% promised payment.
Okay. And now what happens if it declines by 55%, but then it goes up by another, say, 40%? Before the end of the note, before the maturity date, what happens then?
Okay, so for the period that it is below the 50% mark, there would not be any interest payments paid if those are due during the period. Once the price is rebound and you get back within that 50% limit, then the issuer will now resume making payments. There, however, that's a sort of shady area. You have two types of structured notes when it comes to that. If it has what's called a memory feature, then the missed interest payments will be paid, and then you'll resume payments going forward. If it doesn't have a memory feature, then those will be foregone.
Okay, I only want to look at structured notes with memory, Dwayne. Now, tell me something. What happens if the equity price of, say, one of the stocks is below 50% at maturity, at the maturity date of the structured note?
Okay, so if at maturity one or more of the stocks are below 50%, your principal is now affected by the worst performing stock in the portfolio. So let's say Apple were to fall by 55%, then you would be foregoing 55% of your principal and you would be repaid 45%. So that is really the risk associated. So it is very important, especially when looking at structured notes, to speak to your advisor and have an understanding of the underlying assets, how they perform, how they can be affected by current market conditions, future market conditions, so that you can know and understand the level of risk that you're undertaking.
Certainly. And I imagine it would be beneficial to us to buy those structured notes when the prices are kind of near their all-time lows,
right,
for example.
Which we've seen happen very recently.
Right.
And that is why I say if your advisor can guide you to tell you, what the price is during a normal market, what the price fluctuation is during a volatile market, then you can have a better understanding of when is a good entry point and, the possibility of that 50% dip.
Excellent,
thanks. Eugene, do you have anything to add to that?
Yes, thanks. Well, just to add that the coupon on equity structures, based on what we have seen recently, those coupons can range anywhere from 6% to even over 20%.
Wow.
Depending on the underlying stocks themselves and the level of downside risk that you're willing to take, or the amount of downside you're also willing to give up. So for instance, if you're rather than say taking a 50% protection level, you opt for something more aggressive, say 20, 30%, you can improve your coupon that way. But of course, the risk of the note not performing is even greater then. So just remember that the risk reward dynamic. The greater the risk, the higher the expected return, and the lower the risk, the lower the reward. Also, like bonds, structured notes can be called, especially if the underlying stocks perform well. The issuer has the right to call those structured notes. Additionally, there's also a feature on many structured notes called auto call feature, which basically allows an automatic call of the structured notes once all the stocks, which pretty much embed the structured notes, once the prices of all of those stocks are greater than the prices at the time the structured note was issued, then the note will automatically get called. So just bear that in mind. So even though a structured note maybe 3 years, with an auto call feature, it could even get called as soon as the next interest payment date, depending on how well the underlying instruments perform. And then finally, structured notes are not for every investor. I mean, they're highly complex and customizable structures. As a result of that, there is no or a limited secondary market for structured notes. And so structured notes are really geared for the buy and hold investor. And the minimum investment amounts on structured notes are usually between 50 to 100,000 US dollars.
Okay, I appreciate both perspectives. Thanks, guys. So to wrap, we have high coupon, high quality issuers that are paid as long as certain conditions are met. And even if the conditions are breached while we hold the note, provided that the note has a memory feature, we will get back any missed interest payments. And we only lose principal if the conditions are in breach at maturity. So that's helpful, a great way to earn extra income within the appropriate risk for the appropriate investor. Now, that's a cool concept, but that's obviously, as we mentioned, for a sophisticated investor. Dwayne, I am a very risk-averse investor. Now, aside from structured notes, are there any bonds out there paying good income? Your favorite word, good income? Your favorite word?
Well, Marian, good income, it really comes down to the individual investor. So there are a few things that you would have to determine before deciding what is considered good income. The first is you need to determine how much is it that you have to invest. So once you've determined the dollar value of your investment, you now need to look at what your risk appetite is. You have those two things in place, then you need to know, say, okay, based on how much money I have and my needs, what is an appropriate income level for me? So essentially, you need to know have a dollar value in mind of what you need to earn, say monthly, semi-annually, or annually. Once you can give this information to your advisor, the advisor can now shortlist some bonds that will meet the criteria. You can both now have that discussion to say, do any of these really truly meet? And so once they do, then that would, in my mind, is good income.
For sure. Well, that makes a lot of sense, Dwayne. You're saying that my risk appetite and my income needs will kind of determine which bonds I select, which is very helpful. Now, that seems logical, but there are still two big misconceptions that we hear all the time and that definitely prevent people from earning more on their portfolios. And I'm going to start with one that we hear all the time. Dwayne, that bond price is too high. I am certainly not going to buy that bond. Tell us what's wrong with someone who, with my position.
Well, the problem with that position is when buying bonds, what you should look at, more than looking at the price, is to look at the yield. So when you buy the bond expecting a certain yield or a level of return, then it already factors in the bond price. It factors in what you're paying for the bond, and it factors in any call price or what you would receive at maturity. So effectively, you are locking in your yield. A better way to look at it for someone who is looking to generate income is to look at the dollar value of your spend and compare what your annual earning is. So if you put your annual interest over the dollar value spent, you can now calculate your income yield. So you'll see what your true return is based on what you've spent and what you're getting back in hand each year.
That's great. That's simple enough even for me to understand it. What I pay and what I get as a numerator and denominator. I love it. Dwayne, the second thing we hear, you can't make money on bonds because the interest rate is too low. Tell me about that. Is that true?
All right, let me start by saying that generalization is the enemy of the sophisticated investor. Reason being, our traders spend hours each day looking for bonds that are mispriced, undervalued bonds, so that in order to be able to take advantage of them. So there are opportunities out there. It's really for us or for your research team, your advisors to sit and look at these bonds to find them, because there are pockets of value. It's really just finding them and buying at the right time. So there is value out there.
Thanks for reminding us, Dwayne. Thank you. And thanks for trying to reframe the way we view return, because that will definitely help us better assess our investment options and earn more in the long term. Mm-hmm. Now, if we could shift to another investor concern, especially among sophisticated investors that are familiar with the macroeconomic environment. Eugene, bond prices are very high now, although I have been hearing that since 2012. But what happens when interest rates start rising or inflation returns? You know, conventional theory says that bond prices will fall in that environment. How should we view and manage this risk?
Okay. All right. Well, Marion, it is true that bond prices will fall once interest rates start to rise. However, for a person who buy a bond and plans to hold it until maturity, bond prices should not be an issue. Bond price movement should not be an issue for that investor, simply because, that person's income or cash flow will not change with price movements. And so that periodic coupon will remain the same, and also at maturity, the investor will be repaid their face value amount in full, provided the issuer does not default. However, for investors who perhaps don't plan to hold the bond until maturity and are concerned about rising interest rates, there are a few things that they can do to pretty much mitigate the impact of rising interest rates. One response could be simply buying short-dated fixed-rate bonds. So rather than buying, say, a 20 or 30-year bond, they could stick between bonds, say, 2 to 7 years, as an example. Additionally, the investor could buy variable rate bonds or floating rate bonds. With these bonds, the coupon payments will get adjusted on a quarterly or semi-annual basis. And those coupon rates will also increase as the benchmark interest rates increase. So they're looking at higher cash flows at each coupon payment as the rates rise. So that's another benefit of those type of bonds. Additionally, an investor could also use, provided that they're able to obtain them, they could use derivatives to hedge that risk. They could buy, for example, what is called a floating rate agreement or an interest rate swap, and use those pretty much to transform their fixed cash flows into variable rate cash flows, which again will benefit from a rising rate environment. And then finally, an investor could just simply sell their long-dated bonds, take some profits, and either buy a shorter-dated bond, or they can simply place those funds on a short-term money market instrument, such as a repo.
Okay, that's very instructive, Eugene. So you're saying that the income a bondholder receives does not change regardless of what happens to the price of that bond. And also, if an investor is really concerned about inflation or rising interest rates, then they should stay short, buy a short-dated bond.
That's it.
But tell us, Eugene, when should we start to worry about that? What is the Federal Reserve saying about the direction of interest rates right now?
Okay, so, I mean, a significant rise in interest rates should not be an immediate concern for investors right now. Simple truth is, interest rates remain at historically low levels. And when you look at places like Europe, many countries in Europe, there are still negative interest rates there. The Fed recently took interest rates to zero in the midst of the COVID-19 pandemic. And the Fed also plans to keep interest rates at those levels until at least 2023. So we're talking another 2 years or so from now before there's any possibility that the Federal Reserve will increase interest rates. So there's not an immediate concern for rising interest rates at this point. However, we have actually seen, well, certainly since the start of the year, and particularly following the Biden presidential win, we have seen some upward movements on longer-term rates in the United States, particularly the 10-year and the 30-year. And those rates have risen in response to the expectation of more fiscal stimulus coming from a Biden administration and the attendant expectation for higher inflation. So rates have responded on those expectations. Having said that, I don't anticipate that there will be any significant increases in interest rates, notwithstanding. One, if rates were to rise, the expectation will be that the Federal Reserve would intervene to contain those rates, given their overall stance on rates, holding rates as low as they possibly can. And two, we continue to operate in a very low rate environment, so any kind of movements will be modest at best.
Okay, I think we got a glimpse of that in maybe 20, sorry.
One more point on Marion. And this is almost like a paradox. I mean, even though we have seen interest rates rise, certainly on the long end of the curve, we have also seen bond prices continue to rise. And some persons may question that. Why bond prices rising while interest rates are rising?
Yeah.
And the simple truth is that whilst interest rates have risen, credit spreads, which is also another key variable in determining bond prices, have actually fallen for many corporations. And that is as a result of the expectation of a rebound in economic activity, which should redound to the benefit of many of these corporations. So better profitability, lower credit risk. And that has actually translated into higher bond prices. So credit spreads are falling faster than interest rates are actually rising.
Wow.
And that has maintained bond prices, thus lower yields.
Wow, Eugene, that's tremendously insightful. Because you're right, it's a huge paradox.
Yeah.
It's a huge paradox that bond prices are rising, even though yields are rising as well. So a lot of the conventional theory, going back to Dwayne's misconceptions that he tried to dispute earlier, certainly those conventional theories are being disputed. That helps a lot. It sounds like we don't need to rush into short-dated securities then, Eugene, and that bonds are not becoming obsolete as many fear. But I mean, going to the next question then, Dwayne, where can we look for growth outside of the traditional equities market? Where else can we look for growth?
Well, especially during these volatile times, my recommendation generally is to allow a professional portfolio manager to grow your portfolio. So look at investing in managed funds, managed products, mutual funds. The advantage of this is because the opportunities may arise for only a very small window, you need to be able to take advantage right away in order to maximize growth. The normal process, advisor-client process would be the opportunity arises, the advisor contacts the client, they discuss, they make a decision, the they execute the trade. However, the problem with this is it might be time consuming. So the length of time for that to happen, the opportunity may have come and gone. Having a managed portfolio gives that portfolio manager the ability to make the decision, make those trades, and capitalize. So a good example of this would be our mutual fund. For persons, well, most people following the markets would have seen that 2020 would have been poor performance across the board. Our mutual fund still came out positive at 7% despite COVID. For 2019, in a year that was much more stable, the return was 17.8%.
Wow.
When you look at it over the years, it has averaged at 11%, but for persons who went in during the heights of the crisis at around the end of March 2020 are now up over 30% because the fund managers were able to take advantage of what the crisis, and they're benefiting from that. So.
Wow, that is incredible, Dwayne. Hassle-free returns in US dollars. Sign me up right now. And guys, thank you so much for those incredible insights. Structured notes seem very attractive for the appropriate investor, high interest rates with high quality issuers. Certainly, it's good to know, Dwayne and Eugene, that we can still make money in the bond market, both through price appreciation and income. You can get good income, you can get price appreciation despite the environment. And, of course, Eugene, thank you for decoding the FX market, giving us the data that we need to make good decisions. We'll definitely be planning our purchases and sales more strategically. And last, but very much not least, Dwayne, that incredible mutual fund return, 30% from the depths of the crisis, 7% for 2020 on US dollars in a year when most things were down. That's truly incredible. Now that we've actually concluded the formal part of the presentation, I'll just take 2 questions that we have so far from the audience. The first question is, what is the outlook for the Jamaica Stock Exchange in 2021? Eugene, do you want to start us off with that?
I certainly shall. All right. Sadly, whereas international equity markets rebounded quickly and sharply from the COVID-19 meltdown in March 2020 and are poised for even more increase in 2021, when they consider, for instance, the U.S. equities market as catalysts, including ultra accommodative Fed policy, additional government support coming from the Biden administration, and thirdly, vaccination on the way. When you consider all of those things, the international equity market is set to continue to rebound. Locally, however, the Jamaica stock market ended 2020 in a bear market, falling more than 20%, and the decline has actually continued in 2021 with a 3% decline thus far. COVID-19 related restrictions will continue to impact the local economy, and when also consider the hit that COVID has dealt to key sectors such as tourism, which is also a significant employer in the economy, that will continue to haunt the performance of local equities. And then finally, what we've observed over the last 5 or so years that the Jamaica stock market has recorded those brilliant performances was that was tied to a significant amount of Jamaican dollar liquidity into the system. And with BOJ removing Jamaican dollar liquidity at a frenetic pace from the financial system, that is also likely to impact the performances of local equities in 2021.
Wow, so that's quite a contrast to the last 5 years, 22% down in 2020, already 3% down in 2021. Well, thanks, Eugene. We'll definitely moderate our expectations for the local stock market. And I guess, Dwayne, maybe tell us a bit about what investment should we avoid in 2021?
Okay, well, for 2021, well, not just for 2021, but even more so with the volatility.
Yes.
My recommendation would be to avoid distressed debt, avoid bonds that are too high risk. The reason being, if it's too good to be true, it more than likely is. Yeah. That statement is very true, because if a company is offering you very high returns now, and it's outside of the scope of comparable companies, then there should be a question sign. How are they able to offer this? How are they going to be able to sustain those payments? So we really need to know, be able to analyze these companies individually, understand the level of risk, make sure that even if you do go into these distressed debt, make sure it's within your risk appetite.
Right.
So.
That's an excellent point, Dwayne, because we have seen where, and going to Eugene's point about the credit spreads tightening, it's kind of happened all along the risk rating spectrum a bit. So we see where even CCC bonds or companies that aren't making any money are coming to the US capital markets and raising debt. So all the cruise companies, all the airlines were able to come in 2020 and raise debt at 9 and 12 and 14%. And to be fair, some of the bonds have gone up in prices significantly.
They have.
But the point is, I take your point, Dwayne, stay away. Yeah, be cautious and make sure that, you know, it's in the very, very ultra high risk section of your portfolio that you can afford to lose. Mm-hmm. So our final question actually comes from a participant. Can I choose the stock that I want in a structured note? Eugene, is that something that you can comment on?
For sure. And the simple answer is yes. You can choose whatever stocks you want a structured note to be, as well as whatever sector you acquire exposure to, whether it's financial, retail, energy. Like I said, the structured notes are highly customizable. You pretty much can dictate the terms of your structured notes. What the supplier or the provider of structured note will then give you is the coupon that those terms will attract.
Good point. So you can choose the you can choose the underlying assets, just not the coupon. That's what they price.
Or conversely, you can choose what the coupon that you want, and then they will tell you what underlining and what downside protection will give you that level of coupon.
Perfect. Okay, so setting one of the two criteria, I like that. Well, gentlemen, I must thank you for the pleasure of your company and the insights, the value of the insights you've provided for us today. And thank you, everyone, for joining us. And we hope to be able to continue these conversations throughout the year. Thank you all.